We're going to talk a little bit today about strategy. As I mentioned before, this is a session that we're going to make available to all 73 of the MSIC members because we just can't keep up with the demand for strategic planning sessions that we've experienced over the last couple of years. We're here at the Harvard Club. It's June 8th, 2023. And we're going to talk a little bit about strategy and strategic planning. We've just had a wonderful meeting with members of the MSIC Advisory Committee and the Board of Directors, and very helpful, insightful, and it was a really helpful meeting for MSIC as it pursues its mission, and I thank all of you for coming. And we're going to talk about strategy, and we're going to get some questions and comments from the audience as we go. So let's start. First, we have a rising interest rate environment, in case none of you noticed. And we want to talk about the differences in strategy during this type of an environment. First, you're going to get the thumbnail version of what I do with our members when I do a strategic planning session with the board, and some of you may have heard this before. There's a difference between strategy and strategic planning. We do strategic planning with our boards and our senior staff because the regulators require us to do it. They even tell us what we have to have in it, including a SWOT analysis and some of the procedures. And they make comments on how many years it should run. But that's not the purpose of strategic planning. We have to do it, and we do it, and it has some real benefits, but the purpose is strategy. What is the strategy for your institution over the planning period? And what we mean by that is, what should we pursue in order to maximize the opportunity for our institution to be successful over the next few years? Getting to that strategy and building alignment among your board, your senior staff, and frankly, the CEOs, building an alignment over what that strategy is and how we achieve it is the real purpose of doing a strategic planning session. Don't confuse the two. Don't let your board confuse the two. You don't do these sessions to have a plan, nice cover, glossy color for the regulators to read. You do this to have a strategy that helps your institution survive and thrive, and those are totally different. So how long should your planning period be? We recommend 2 to 3 years. Any less than 2, you won't have enough time to pursue a true strategic objective. Any more than 3, I have trouble anticipating the next 2 months. I don't know how you could anticipate the environment of the next 4 years. So I think 2 to 3 works. The other general suggestion is, do not let someone else write your plan. Hire a facilitator if you think your board needs that to achieve that alignment that you need to help build consensus, but you write the plan in your voice. That's extremely important. Consultants that come in and say, we'll write it for you, we'll do it for you, is not worth the paper it's written on. Many of you know I used to be a regulator, and I was a regulator during a period of time in which there was a big crisis in Massachusetts and New England. And so we had 10 savings banks that were in trouble, and I asked the Division of Bank staff to pull their strategic plan so I could read it and see what was going on with these institutions and what their goals were. We pulled in 10. They shall remain nameless, of course. They were all done by the same consultant. I read them all. It took me about 15 minutes. They were word for word the same. Only the names were changed, and the consultant's name was right on the front. They were verbatim. On one of them, I guess they didn't know how to do a global search. On one of them, on page 15 or so, they had the wrong bank name. And so they had each paid for a consultant to come in and do the strategic planning process for them. That consultant pulled a standard agreement, changed the names, and submitted it to the regulators. Okay? What do you think I thought about that? Don't let somebody else write it. Write it in your voice. Of those 10, 5 didn't make it through the New England banking crisis. And I never recommend that consultant to anyone because they were banking on the fact that the Division of Banks uses what's called stovepipe regulation. They did then, they still do it now, even though they say they don't. And that is, teams look at each individual institution. And at that time, in 1991 and 92, they didn't have any systemic analysis going on. So the teams never saw that it was the same strategic plan, and nobody knew that. But that's a disaster. Write your own plan. Have your facilitator or consultant edit it for you, give you suggestions, help you with some standard SWOT materials. Do that, but make sure you're doing your own. And remember, the number one goal of your strategic planning session with your board is to build consensus. You already know what you need to do. If you're a CEO running an institution every day, you already know what the big issues are. Find out what's going on in your marketplace, make it specific to you, and build consensus around a set of realistic goals. Now, there's another issue that we always say, don't reach too far. This is a problem I have. I have a tendency to reach too far. You want your strategic objectives to be reasonable, to be minimally acceptable, and that you can exceed. Sure, put in a couple of stretch goals, but you don't want to overreach in your plan. You can overreach in your plan and hit 75% of it, and the regulators will come in and slap you about the head and say you missed 25% of your plan. I would rather you do 50% of what you really want and get 60% of what you really want, and you are a hero. Be thinking about how you structure your exam process. All right, so let's talk about the background, because there's two things you have to do. You have to look at the environment in which you're operating, and that is a statewide, regional, national, global set of conditions. We're going to talk a little bit about that now, but then you need to make it precise. You need to talk about your membership base and your market area and your staff and your capabilities. It has to be very specific to your institution. So there has to be a lot of advanced planning. Before you go into a strategic planning session, you should have an idea of what you want to get out of it, what you think you can achieve, and then try to build the consensus around those goals. Nobody knows the institution as well as the CEO. So let's talk about the environment. So we've had 20 plus years of a declining interest rate environment. These are the actual numbers. Look at the 10-year Treasury yield, and you see a slope like this. See it? That's the lighter gray in the back. Downward. So we have an entire generation of CEOs in their leadership roles that have never experienced anything but a consistently declining interest rate environment. That has a lot of implications for your business model. A lot of institutions are living off of, have lived off, loan refinancings. There aren't any more of them now. You've now turned to a sustained rising rate environment. In that very last segment, you see how dramatic that increase is. We've had it before, and we've had a number of dramatic downturns. You can see the most recent crisis, the generational low rates at just above zero. Zero, by the way, is called the zero lower bound for the Federal Reserve, because if you go below that, you're now in negative interest rates, you've got deflation, you've got some very serious economic problems. So we were at the zero lower bound for, 2010 to 2016, and again with the crisis now. So this is a new world for our CEOs and our institutions of a dramatically rising interest rate environment. So the first phase of that, with that spike up, is you're going to have better investment income due to repricing of your investment portfolios. The danger, of course, is you've got unrealized losses on your investments. You can't sell them without recognizing those losses. Sometimes those losses are significant, depending upon how long you went on your investment during this generational low interest rates. So you can't sell them You'll have to hold them to maturity to avoid the loss. The loss accretes to zero if you hold it to maturity. So investments will not be a source of your needed liquidity. You'll need to maintain high levels of liquidity for other sources in a rising interest rate environment. Hopefully, you kept your investment portfolio in cash and other short duration investments during the generational low interest rate cycle that we've just come through over the last several years. And of course, Silicon Valley Bank should have been listening to MSIC because we've been advising this for 3 or 4 years now. Keep it short, don't reach for yield, because sooner or later, interest rates are going to go back to more normal levels. We didn't expect them to go this fast, but we're not fully surprised. The second phase, which really happens in conjunction with the first, is much higher cost of funds. And you're all seeing that already. This has already happened since the end of 2022. And that's going to significantly compress interest margins and reduce your overall earnings. Cost of funds goes up fast and comes down slow. So here's the risk. Now, these are not real numbers, these are comparative numbers. In year one of this new world of interest rates, you're going to have dramatically higher cost of funds, and your investment portfolio will reprice to help offset some of that, but it won't be enough to cover your cost of funds. Your loan portfolio repricing will be very low. As I said before, there are no refinancings going on. Your loan pipeline has gone to zero, new loan income is way down, and because borrowers have had generational low interest rates, they're going to keep those 3% mortgages for as long as they can. So you're going to have a lower, slower loan portfolio repricing in terms of your bottom line, and your new loan income is low. In year two, you're not going to have that immediate investment portfolio repricing. It will be less. If everything's in short, if you've got most of your investments in 1 or 2 years, you'll get the benefit of that repricing in the first year or two, and then it won't reprice, especially for your long dated. But your cost of funds in year two will still be elevated. There's no way around this. This scenario means compression of your net interest margin and real pressure on your earnings stream. So we recommend that you take command of your balance sheet and income statement, use a long view perspective. There's no business as usual. All items need to be on the table, and have a sense of urgency and drive that perspective with your staffs. Urgency, urgency, urgency. And we'll talk about why that's important in a little bit later in the presentation. You should consider a substantial increase in your fee income. I know in Massachusetts that is going against the Catholic Church, because we are a low fee culture. We are a low fee. We pride ourselves in being low fee, but we have a significant lag in the national credit union industry on the average for fee income. As a matter of fact, all of the national credit union industry's net income for last year comes from their fee income. Their fee income equals their total net income. And it's much higher, 3 times higher than what we do in Massachusetts. Now, you should be looking at doing this so that you can be competitive with your other institutions in your market area, and you can also reduce those fees when good times return. But it's very likely you're going to need every source of income you can to maintain profitability and attain break-even, and you should really seriously look at this in conjunction with the industry as a whole. Manage your cost of funds. You need to drastically hang back in the market. When the market is raising rates fast, you need to make a decision as to whether you want to compete at those, whether you can compete at those new higher levels, or do you want to hang back, slow it down, let some deposits run. Figure out what is more profitable for your institution in this period. I know we work hard and long to build a franchise, to bring in depositors, to bring in members, to bring in loans. But you have to decide whether or not you can sustain this rapid rise in your cost of funds. You may want to let member deposits decline. You have to analyze it at every step of the way. What is more profitable for your institution? You have to avoid special high rate offers unless you need liquidity, unless you need to draw in funds. Budget a target increase in your cost of funds that your credit union can afford. Do that now and manage to that number to the greatest extent possible, realizing, of course, that you really don't control it. But you've got to try to manage it as best you can. You have to monitor your cost of funds often. This is a CEO level job, not anybody below that. You have to look at that in the context of your overall operation. Cut your operating costs now. Become more efficient. Teach your organization to compete. We talked about this before. We've become reliant in our loans, especially on loan refinancings. Well, let me tell you, that means your organization gets pretty lazy. Sorry, no insult intended. We get used to the walk-ins. We get used to our existing members seeing that the rates have gone down 100 basis points, coming into your shop, giving you the loan to refinance. Good for them, good for you, and your whole production is in this cycle. That's not what's going to sustain you now. There are no more loan refinances. The most unproductive area is likely to be your loan operation due to the dramatic decline in loan pipelines. That's going to continue. It's going to get better. It will get better, but the numbers of mortgage loans out there will be far lower than they were when we were at generational low interest rates a year or two ago. Reduce your loan processing costs and other operating costs to maximize immediate profitability. You have to write loans that meet secondary market standards. You're creating enormous risk for you if you don't underwrite to secondary market standards. Loan portfolios are the biggest asset you have in almost every case. If you can't sell those when the interest rates require it, then you shouldn't be in the mortgage business. You don't know what you're doing. And there's a lot of risk in the mortgage business. Don't allow your staff not to write to secondary mortgage standards. You may want to keep them in portfolio, but you may need to blow them out at some point in the future, and especially during the last few years. If you've kept all of your 3% mortgages on your portfolio because it was easy and your staff didn't know how to write to secondary mortgage standards and it was cheaper not to write to secondary mortgage standards, you're in big trouble because that portfolio will remain underwater for the foreseeable future, and that's going to be a real drain on your net income as we go through this. Evaluate your branches. Determine if they're profitable. Consider closing unprofitable branches, holding off on new products and services if they require significant capital or staffing costs. You're managing to the bottom line, and this is a tough period. A lot of your boards don't understand that because they don't know the business the way we all do. You really have to think seriously about improving your competition while lowering your operating costs. And we all know that's really tough. Build your loan pipeline. Remember the chart that said loan repricing and it was way down below cost of funds? You've got to build a loan pipeline. You've got to build new members. You've got to bring that in to reprice your loan portfolio, and you have to do it in the most competitive market any of us will have seen in 20 years. Get more loan originators, bring in loan products and new members, underwrite to secondary market standards. With each loan, you should determine if it is better, meaning more profitable, to retain the loan or sell it immediately in the secondary market. If it can be sold at a gain, selling will be preferable to generate immediate returns as your net earnings become less. Remember, we're talking about a 2-year horizon here. We're talking about a crunch. These interest rates are not going to go back to the lower zero bound. There may be a 25 basis points decline. There may be a hold. There also may be another increase. We're in this new world for the foreseeable future because of inflation and other broader economic interests, you got to go out there and generate returns and bring in new members in order to maximize the improvement in the yield on your loan portfolio. The age of living off loan refinancing is over, and we have not seen in our membership what we really should be seeing, and that is you're way overstaffed in almost every loan operation. If your loan operation is of any size, you are carrying folks that you can't afford. They're all good people. We all want to keep them. It took you a while to get them there. I hate to lose them, but you either got to massively increase your portfolio so people are working at least 40 hours a week, generate more loan product, keep them busy, or you got to think about whether or not you can sustain the next 2 years at those levels. Even if you do all that, your loan portfolio is turning a battleship. The yield on your loan portfolio will improve like trying to turn a battle. It takes 2 miles to turn around an aircraft carrier. It's really slow. Cost of funds is a jet engine going straight up. So cost of funds are going to do this, and your whole organization is going to try and improve your loan yield, and it's going to do this. You see where the danger is in the next couple of years. ARM-based products, HELOCs, second mortgages, good, go after them. They will adjust with the interest rates. But remember that those products historically leads to more delinquencies, especially if we have a recession. So you also got to be thinking about how much of the portfolio should be in an ARM-based product. You got to have balance, you got to have some. It will be the fastest way for you to improve it, but you also got to be thinking down the road, if we hit a recession, ARM-based products are going to create more delinquencies than you were used to. Therefore, you're going to need more loan loss reserves. Again, this is balance. What will work and what won't work for your institution. So, if you got very low fixed rates due to the consumer demand, it's going to slow the repricing of your portfolio, but it will also minimize delinquencies in a rising rate environment. The one good thing about having a portfolio of 3% loans is they're not going to go delinquent on you unless it's absolute disaster in the consumer's life. And even then, they probably have the ability to pay off the loan and sell the property, hopefully, depending upon what happens to the real estate market. But we do predict higher than average delinquencies going over the next 2 to 3 years. Investments. As we said before, you can't sell your investments due to the unrealized loss position in almost every case. Some of our members have a significant unrealized loss position. So as they come to maturity, you have to make a decision right then and there. Is it better to reinvest that into higher yielding investments and get that immediate gain? Well, not immediate, but that gain in your overall yield? Or is it more profitable for you to use that to cover the runoff in consumer deposits by keeping your core deposit rates low? That's an affirmative decision that CEOs have to make at that time. It is not the case in a rapidly rising interest rate environment that having a sole goal of growing your asset size is not necessarily the right answer. How do you maximize your profitability in this environment? That's the decision. And some of our most profitable members have had substantial runoff in the last 6 months, and they've done that as a strategy to improve their net income position, and they've let it run off rather than compete at a much higher rate. Borrowings. You got to have them if you need liquidity, but are they going to cost you more or are they going to cost you less? They're going to cost you way more. And so you really need to find a way to minimize those borrowings if you can. Have a line of credit with the Federal Home Loan Bank, don't use it. Be ready to use it if you have to for liquidity purposes, but you really got to try and get your borrowings down so that you can minimize your expense on the liability side. Liquidity, name of the game. Just ask Silicon Valley Bank. Liquidity liquidity, liquidity. How do you maintain liquidity when you can't sell your investments? How do you maintain liquidity when you've got no loan pipeline? How do you maintain liquidity when you got to lower your interest rates? It allows some deposit runoff. Going to be tough. This requires CEO attention daily, weekly. You got to figure out from other sources how you can maintain the liquidity of your institution in light of where consumers are today. Loan loss reserves. This is a simple one. We got all kinds of requirements, regulatory and accounting, as to what the loan loss reserve is. You got to comply with those requirements. While you're profitable, fill it to the brim. Put it in there. Fill it up. Have your outside accountant say, Mike, you really overdid your loan loss reserve. And Mike will say, gee, I'm sorry, Markham, but I think we're going to leave it there for now and see how it goes next year. You want to build it as much as you can, because later, if your loan pipeline comes down and you're over-reserved, you might be able to recapture some of that to help you next year or the year after when you've got profitability issues. Now, every CPA in the room and all of my friends in the accounting industry will say that I'm pushing the envelope. Yep. I'm pushing the envelope. And they'll tell me when I go too far, and the regulars will tell me I go too far. But if you're over-reserved right now, great idea. Great idea. Try to hold it to the point where you may need a recapture in order to hit break-even. Got to comply with the rules, accounting and regulatory, and you got new rules that are coming into the fore now that are making it very difficult. But when you're profitable, reduce your profitability now to the extent that you can improve your loan loss reserve. You may need that in the future. Same thing with accruals. If you're profitable now, boost up your accruals. Got to be legitimate, got to meet the accounting standards, got to meet the regulatory standards, but later on, if you decide to change a strategy or you alter a plan or you delete projects later on and you've got a nice accrual for it that you put in there when you were profitable, you can reverse that accrual, and it might be a nice weapon in your back pocket to use when you're struggling for profitability and break even. So again, talk to your accountants, talk to your CFO, boost your accruals if you are profitable now. Consumers. So this is a little different than I normally talk about. We're in the midst of a banking crisis. It's going to continue to adversely affect mostly mid-sized banks, not us. We're in very, very good shape as an industry. I think more bank failures are likely and bank runs are possible. Consumers are scared to death right now. There's war in Ukraine. There's massive inflation. As I said earlier, we're in the midst of a presidential campaign. Couldn't be worse. This is like the perfect storm of bad news. Whether it's true or it's not true, consumers are hearing it and they're worried. They're very jittery. That's part of Silicon Valley Bank's problem, was that there was consumer fear that erupted unexpectedly and they pulled out $46 billion in a single day. Consumers are scared. Don't give them any reason to be scared of you. Keep in touch with them. Talk to your frontline staff. Have them chat with the consumers. You've got to distinguish your organization from the failing banks. You've already done a great job with that. We had a big contagion effort a couple of weeks after Silicon Valley Bank. All of our members did a great job. All of their frontline staff were trained. They really allayed the fears of consumers. But that's not a one-off. You've got to keep doing that. Keep in touch with them. Find out what they're worried about. Keep distinguishing you from the problem institutions. You got to provide accurate information. You never should mislead them, but you got to teach your staff how to give consumers the ability to rationally evaluate the risk and to see that they're fully insured with you. It couldn't be better. You're good. Make sure your consumers know that. Follow our contagion response guidance and keep your staff with that front of mind. You also have to do something that we're not typically very good at, and that is monitor social media commentary. Don't ask me. I'm in my 60s. I have no idea how to do that, but all of you have some young people on your staff that know how to do that. You want to hear what your consumers in your market area, to the extent you can identify them, you want to know what they're talking about banking generally and your credit union specifically. If you hear something through social media, you have to be prepared to respond immediately to false and dangerous misinformation. Your marketing staff should be doing this. And hopefully you're not putting ads in a newspaper or doing traditional marketing because nobody listens to that anymore. They need to be doing this. This is a defensive role now to nip in the bud problems before your consumers panic. You got to be vigilant. You got to stay at it. Your staff has to do it all the time, and you have to show confidence. Remember, 90% of the game is never letting them see you sweat. That's an old TV commercial when we used to watch TV. Never let them see you sweat. Be confident, have your staff be confident, be accurate, and tell your story because consumers will be very pleased with the story you have to tell. This, right here, is a weapon of mass financial destruction. Right here. We live in a new world. Bankers don't get it. Credit union CEOs don't get it. Regulators don't get it. Congress people don't get it. This thing can destroy all of our institutions in a day or two. Don't ignore it. Don't ignore it. Stay in touch with your consumers. Board of Directors. So as we said in the beginning, a major objective of strategic planning is to achieve consensus in your organization. A strategy, you're looking for a strategy that maximizes the success of your organization. Especially in difficult times, your board and your senior staff have to be plugged into this process. Your board has to be plugged into this process. They need to know what the challenges are. Deal with those challenges up front. Educate them. Get them on board. Make sure if they've got misconceptions, they understand those misconceptions. Let them know that you're going to be challenged for profitability. Don't hide it. Tell them why. Use this presentation. Call us. We can get your resources. Your board's got to be on top of this. You can't wait till the crisis happens for your board to understand the risks ahead. Now, the other thing you need to do is you need to monitor your performance and help the board monitor your performance, and you got to modify your plans as circumstances warrant. And in these times, those circumstances happen fast. Always be monitoring your plan. Always be monitoring your strategy. Always be monitoring your performance. And when tweaks or major things need to happen to anticipate a problem, do it immediately. You have to have wide-ranging authority from your board to act. Not wait for your next board meeting to talk about your ALM decision. Get them to understand the issue. Get them to give you the authority to do this. Ask them to ratify your decision at the next board meeting. In a crisis situation, that works. Waiting while you see that there's a problem for 30 days until your next board meeting, that doesn't work. This happens at the speed of lightning. Build and maintain resilience in your organizational structure. That's really important. That's really hard. It requires constant CEO work, but your board needs to be as resilient as you are. Need I say more? You got to do it now. Increasing cost of funds in a dramatically rising interest rate environment hits your P&L like a train wreck. That's actually a really good analogy. It comes out of nowhere and it destroys everything in its path. You can't wait. If you wait until that hits your P&L, it's too late. You'll be reacting and your problems will be greater. So you have to make the changes necessary to maintain break even. I put profitability up there, but the name of the game over the next 2 to 3 years is maintaining break even. If you can be profitable, your board should congratulate you. You've got to maintain break even and seek profitability by taking some really dramatic actions in this environment, because your cost of funds is not going to come back down. It's going to go up, and we are used to having a very low cost of funds. That's the scenario I think we face. So, CEOs, this is what we get paid for. I don't want to see any long faces. I don't want to see any complaints. This is why we have the jobs that we have. Take command now. Make actions now. Do the things necessary to whip your organization into shape. And then 2 or 3 years from now, we can all celebrate as we all got through it. Questions, comments, disagreements? Anybody have a different view? As I've always said, I don't get asked back very often because the story we tell at MSIC sometimes looks a little negative, but we really have some challenging times ahead. If MSIC can help, please reach out to us. Thank you very much. Good. On cue. I like that. On cue. We got it on tape. Very good. Very good. Questions, comments, disagreements? Am I on the mark? Are we close? Are any of you seeing this?
Mike,
yeah.
So fees. So during COVID, we got rid of a lot of fees, and we're slowly getting them back up. So fee, credit union land, we just don't like to do it. So that's really important. And then also your comments, knowing the niche. We have to know our niche, don't try to be everything to everyone.
Yep.
But,
So fees are really tough. It's a really tough issue. And, I thought, over and over, what do I say about it? But when you look at the national numbers and then you look at Massachusetts numbers, if we're earning 50 or I think we earn 63 basis points, our membership on average, which is good for 2022. It's come up in the last few years. The national industry was at 88, and the year before they were at like 112. And the difference is all that they're charging more fees. Now, part of that is the national industry does way more consumer loans and small loans than we do. Their portfolios, we got into mortgage lending in Massachusetts way before the national credit union movement. And our portfolios are really dominated by mortgages, so you have fewer transactions. So some of those fees are basic fees because they're doing a 2-year, 3-year consumer loan or auto loan, and there's some fees associated with that. And so part of that is that. But the other part is we're probably not charging fees at a level that are appropriate for this environment. Now, think about it. If you make a decision to run off some of your deposits, and some of you can do that and some of you can't, I get that, but if that's your decision, bolster your fees. Some folks will leave. When times get good or we're through it and you're back to profitability, you can lower your fees, you can make a big announcement about it, they won't remember. I think there's an opportunity here to do that, but I understand fully that I am flying in the face of a long-term Massachusetts cultural benefit. We've marketed for years that we don't charge our members fees, and that's a wonderful thing. This may be the time to take a good look at that, not for the long term, but for the short duration that we're in. And I know that 2/3 of our members will ignore that advice, but that's okay. I'm at least saying you got to look at it in order to maintain profitability. Comments, questions? Just remember that I hope I'm wrong on this. I'll be the first guy to buy the beer at the party when it becomes that we're wrong on the cost of funds and the portfolio. But I think we're in for a real tough ride on break even and earnings over the next couple of years. The good news is our membership has 11% capital. We are really strong. We are really, as a group, really in great shape to weather this, but I think we do need to prepare now as best we can for some rough earnings times as we go forward. Other comments? How was the food? Did they serve dessert? Yes, they did. Good. I hope you enjoyed it. That's all we have. Unless you have comments or questions, stay as long as you like. But thank you for coming. Thank you for being the audience. Thank you for applauding at the right moment. Always good. And I enjoyed this, and I got a lot out of it, so I hope you did too. Thanks again.
Thank you, Mike.